Beat the bear market with tech stocks. That's what I'm talking about today. My name's Jeff Beers. This is the 40 Finance channel. Let's dig in. So if you follow the stock market, you've noticed that we're coming out of 2019 or into 2019. We've had a really big downturn, Chinese trade fears, Apple stock, you name it. It's hit the stock market pretty hard. And the thing that surprises me throughout it is even though all stocks are dropping, there seems to be like this nitpicking on a lot of the tech stocks, in particular, Facebook, Apple, Amazon. I pulled some headlines here. They're all just negative headlines, right? So if you're not paying attention on a daily basis like I do, you might get the feeling that, hey, you know, tech is crashing, FANG is crashing. I got to get out of there as soon as possible. The house is burning down. It's over, right? Well, if you think that, you're probably going to lose in this bear market run. And these are the growth sectors of our economy, and they're only going to get bigger. Even if you look at older industries like automobiles, housing, industrial, they're all going to be powered with technology. That's what's going to help them grow. So by taking advantage of a recent dip in technology, you can really set yourself up to make huge gains over the next 3 to 4 years, and maybe even sooner. I'm not so sold that this bear market is going to last for much past 2019. Okay, so the jury's still out on that. It's pure speculation on my part. But a lot of the consumer indicators are really, really good right now as far as jobs reports, income reports. The problems are with future earnings and a potential slowdown, not a turnaround, not a downturn, just corporations are still making a vast amount of money. They're just making it on a smaller pace. So if they were plus 7% 2 years ago, they might only be plus 3 or 4% this year. And when things don't grow every single year at the same pace, you know, investors get a little nervous. But in my eyes, profit is profit, and the future still looks good. Okay, so I pulled this slide just to reiterate my thought on tech as compared to some other experts, okay? So this is the tip ranks most recommended stocks by sector. It's just for the top, whatever their rating is for top experts, okay? So it kind of eliminates some of the noise. So blue means how many stocks in the sector are being recommended as strong buys. Then purple is the opposite, which is strong sells. And then everything in gray is just sort of a holding pattern. All right, so right at the top of the chart, you see that healthcare right now has the most buy signals for stocks, okay? And that makes a lot of sense if you've been following healthcare. There's a lot more opportunities coming to those companies. There's a little bit more conglomeration in there. And healthcare by its nature always has not only a ton of innovation, but it has a ton of small stocks that usually go up pretty quickly because they invent a new device or they get some pharmaceutical drug trial that looks positive. So there's a lot of people that live only in healthcare sector to try to make money. I actually live mostly in the technology sector and consumer goods. And you can see technology, for as much as it's been beaten down, okay, and as much as the news headlines are sort of negative, it has the second most buy signals for stocks out of all the sector, okay? Right next to it is consumer goods, which, oh, by the way, has a pretty strong share of technology stocks that you wouldn't even think were in the consumer goods department. Cisco, just a quick one off the top of my head, is in consumer goods. Okay, so a lot of the consumer goods that they are telling you have potential for 2019 are really based on technology. The opportunity in America is tied to technology, okay, over the next foreseeable future. So I see some videos with dividend players. I see videos with or analysts talking about go to safe stocks like utilities and consumer staples. That's not necessarily a bad strategy. That's a one way to protect. That's a defensive strategy. But in order to go, let's say you're all in FANG, and then you wanted to go over to all consumer staples like Clorox and P&G and whatever, and just live on dividends. Okay, well, if you do that tomorrow, you're selling at the bottom of technology. So all the gains that were made, you're selling at the bottom. Then you're basically buying at the high of consumer staples, okay? Because a lot of the old school money is doing exactly that. They're going to the dividend plays. They're hiding out until things get better. I see the opposite, right? I would argue that you should be selling consumer staples because they just got a price boost because everyone bought in over there. And you should come over and buy the downtrodden tech sector, which almost inevitably will not be down for much longer. Certainly not going to be down for long because the whole world is based on innovation and technology, okay? So those are some things to consider. You can, dividends, especially some of those old school consumer staples like Clorox or whatever, the dividends are pretty high. I mean, you can get 3% or whatever over there, which is not bad. My personal take is if I have $10,000 and my choices are Clorox and Procter & Gamble dividend paying consumer staples, and then a technology ETF, going technology ETF without even question. From a long-term growth standpoint, I'm not even blinking at those choices because you're going to see that the old school consumer staples, as I'm calling them, the growth opportunities are very, very, very limited, okay? You think about things like Colgate toothpaste and Tide detergent, like where's the growth? At an age when people are looking at secondary brands that they associate with on TV that get celebrity pitches, those secondary brands are all coming up into the grocery store shelves. It's death by 1,000 cuts for Tide and everybody else. No one believes anymore that your Colgate toothpaste is the only single way that I'm ever going to get my teeth clean, right? Or a Crest toothpaste is the only thing that works, period. If I don't buy it, I'm an idiot. That world is gone. And those brands are strong. They will still resonate for some time, but the growth opportunity is very limited, and I think that's what you have to keep in mind. All right, so just to prove a point on the technology ETF, this is my favorite one, and it represents a solid 25% of my personal holdings. The FDN ETF, I've done a video on it before. Here you see, if you go back to the last market crash, right, which is in between 2007, 2008, the lowest point for the FDN came approximately in November of 2008, where the price was $13. Okay, so if on that day, which was almost dead on 10 years ago, if you would have bought 100 shares at $13, you would have spent $1,300, right? And today, even after the downturn, okay, even after the downturn, the price is $114. All right, so that's a pretty good setup as far as if you wanted to buy low and later sell high. 10 years is all you would have needed to do to go from $13 a share to $114 a share. And this is an ETF. It's based on all the ones you've heard of. It's Google, it's Amazon, it's Facebook, it's all the big players. Do your own research. There's other ones exactly like it. There's other technology stocks that are exactly like it. There's plenty of choices on the market. I like this one because it's not equally weighted. It's more like a market cap weighting. So the big it invests more in the strongest companies, but it still has representation across the whole group. So that's my personal preference. You can find others, though, that do it a slightly different way. All right, so for this last chart, and you talk about, well, hey, Jeff, what if I was in Clorox? What if I was in P&G or whatever the example that you have is. This chart compares the NASDAQ Composite, FDN, which was the ETF I just showed you, and the Dow Jones Index indicated by the SPY ETF. So what you see here, and hopefully it's visible because I know that the sun's out and it might be hard to see. So this is 2006, okay? This is the last big market crash with the housing crisis, etc. FDN started right here. It looks like mid-2006. I wasn't in it at that point, unfortunately. But you see the lines, okay? So black is FDN, and over that time, it's up 1,400%. NASDAQ, mostly technology, almost all technology, is up 648%. And SPY, which is your Dow Jones stocks, which includes some tech as well, but you also get the big names in that the dividend players are always talking about, right? The Cloroxes, the P&Gs, all those guys, General Mills, Heinz, all those things that people are talking about when they're talking like the dividend aristocrats. Most of those guys are in there. So not bad companies. That game would have been up 100%, okay? So here's your choices. Over the past 10-ish years, from the last big market crash to the housing crisis. Okay, you wanted the ETF for the Dow Jones? 100% gains, good job. You want an ETF that tracks the NASDAQ? Up 648%, really good job. So 6 times better, good job. The ETF that I've chosen to invest in, FDN, in that same time frame, is up 1,400%. So it's literally the Dow at 100, 6 times better if you are in just the NASDAQ technology, I don't want to say sector, but most of NASDAQ stuff is based in technology, rooted in technology. So 6 times better with just taking the NASDAQ instead of the Dow, and 14 times better if you went with the Internet Composite, which is what the FDN is. Guys, you can put all the dividends in the world into these calculations, okay? Because this is just price. So that's an important call out for the Dow Jones guys. The dividends would have brought this up more, for sure. So that's just 100% on the price. Dividends would have padded some of these as well. Now, tech stocks don't have as much dividends, but no, this is without dividends. Okay, so make sure that you understand that. Now, what do most people do with their dividends? They buy more shares. Okay, so the price of the stock is still relevant. The only difference is you basically get a discount on the price if they give you $3 a year, then you get $3 off the next time you go buy it. So it's not a bad strategy. It's certainly a really good defensive strategy and a really good safe strategy. But if you are looking for quicker growth, which is me, okay? I'm in my 40s. I have 3 kids. I got one of them who's 12. College is on the horizon, okay? There's a lot of things that are on the horizon, even outside of my just sheer retirement, okay? So I need bigger gains. I'm willing to risk a little bit because I think when you put into an ETF, you spread your risks out. And this is the kind of returns that I need, though, for my personal goals. So I hope this helps you in regards to the current bull market. What should you do with your money? My vote, my opinion, without question, is to buy the downtrodden tech stocks now at a discount, ride it out, keep adding all the way through 2019. And if you're lucky, not even lucky though, really, if you're patient, in 10 years, I don't see any reason why you won't wake up to a chart like this, which is absolutely phenomenal performance. My name's Jeff Beers. This is the 40 Finance channel. Hey guys, I'm grinding away trying to build up this channel, so please like and share if you can, and I'll see you on the next video.